Real estate is about freedom, choice freedom, time freedom, and money freedom, and the impact you can make with that freedom. But it doesn't come without cost. Your freedom takes work. That's why Neil Timmins brings together the tools you need to build your real estate legacy, from tips and tricks to interviews with industry titans. It's all here in one place. Real Grit. Let's get to it.
Hey, everybody, welcome to Real Grit. I'm Neil Timmins. Hey, I've got Lee Kearney here. He's one of the nation's most successful single-family investors. Since 2004, he's bought and sold over 7,000 properties. He's known as an expert in leveraging real estate in cycles. The SPIN flagship trading company has sales exceeding over $500 million to date. In 2022, a large focus for SPIN was capitalizing on the resurgence of foreclosures through its direct-to-seller model, combining technology, data mining, sales, and marketing. So I'm excited to have him here. Lee, how are you?
Doing good. Yeah. Thanks for having me on the show.
Oh, I'm excited you're here. You've got a tremendous amount of experience, but before I dive deep into that, just tell me, where'd you even begin?
Well, my first property was actually a flip by accident in 2003. I bought a penthouse back in Ireland. When I say penthouse, it's a glamorous term for a downtown condominium that happened to be on the top floor. So bought it, got broken into, and decided that I needed to sell. I didn't feel safe there. So I sold it and actually cleared a profit that was larger than the job I was working at the time. And so that's when I realized, okay, there's some serious money in real estate. If I can do this by accident, how do I do it on purpose? Yeah. And it goes back to a business lesson from my father, which was you buy low, sell high. So when I dove further on that, he said the key is to source it from places that people don't know where you're buying it from, which allows you to buy it at a discount. Sure. So I applied that to real estate, went out to California, ended up at the time was going to church with someone that ended up becoming my coach, was a flipper. So I got a buy box from him, buy in this area, buy at this price point, and went to work. Now, interestingly enough, the buy box and the grid he gave me, it took me 4 months to buy my first property. Yeah. It ended up being a probate. No idea what a probate is. Okay. I used an agent because I didn't know how to find the deal myself. I just literally called the agent going, I need a property at this price in this area. And she would just shoot me properties several times a week. And I'd go drive them in the evening after school. I was in college out in California and bought it, rehabbed it, found out the big thing in Southern California was to put sprinkler system and sod. And so I put that down, made the grass look green compared to all my neighbors. This was in a really tough neighborhood, but turned about a $30,000 profit on that first flip. Did put the signs out like my coach told me, did everything. I decided to do a second flip. And that's where I made a bunch of mistakes. Hired a friend to do the rehab, big mistake. Yeah. Moved back to Florida, tried to rehab it remotely, big mistake. Didn't realize the market was softening. And actually, in looking back in history, in 2004, there was already a softening in the market in California. So dove in 2005, asked a bunch of questions. So if you're out there listening to this, ask a bunch of questions. There is no stupid question. Didn't know what probate was, didn't know what a foreclosure was. Yeah. One of my friend's fathers told me to buy foreclosures. So started buying foreclosures, and that's really where my career started is 2005, became a huge courthouse buyer.
So you were buying foreclosures before buying foreclosures was cool, meaning before the downturn.
Well, I'll even double down on that statement. I was buying HOA foreclosures for $1,000 or less, renting them out for double that amount and making, 10,000, 20,000% of my money back when that wasn't even a discovered way of investing. So there's lots of things that, as I look back, just having the drive and the energy and just the motivation and being an executor, I end up stumbling upon tactics that I realize now people weren't even doing back then. And, it worked out great, which is something we spoke about right before the show. In an upward market, I looked like a hero because all I was doing was riding the wave of 2005, 2006, which was an upward market. Right. Made a bunch of money. But in 2007, when the market slowed down, I'm still buying properties from wholesalers, still buying at the courthouse. And now I'm selling for stuff for less than what I paid for it after I put money into it. My world crashed. I had $30,000 a month in outgoings, just mortgages and payments, had nothing coming in. In fact, it was just still checks out. When I closed the property, it was cash out again, paying off hard money loans. And I found myself at the end of 2007, completely out of powder at that point. I told my wife at the time, we're going bankrupt. thank goodness we actually avoided bankruptcy. And I did everything in my power for almost a year to avoid bankruptcy, get everybody paid off and get a fresh start. And that's when I looked around the market. I said, what did I do wrong? So I learned a couple lessons back then. Number one, it's not important to call the bottom of the market, but you better call the top, because as soon as the market slides the other way, it's a free fall. But when it was at the bottom, as we look back at 2008 to 2012, that trough lasted for about 4 years. And so the other thing I realized too is at the top of the market, you don't want to own a bunch of real estate, you want to control it. So you buy at the bottom, you control at the top. And the third lesson I learned is that there's always money in there's always money in real estate. You just got to make sure you're on the right side of the trade. If I was a wholesaler selling to people like me, I was making $20,000 a house. If I was me being the buyer paying the fee, I end up taking on an asset, owning it, and losing money. So with that being said, all we did was flip strategy, became a wholesaler, became a huge wholesaler in 2008, 2009, and made back that money in little to no time. And in fact, I look at that first year of just really putting my foot down on wholesaling, and did about $1 million that first year. So
you indicated it's more important to not buy at the top than buy at the bottom. I want to go into that just a little deeper because you touched on it. The bottom typically lasts for a period of time. And you said, 4 years, the historical time frame. It pretty much sits on the bottom or darn near the bottom, but
nobody wants real estate.
Lending practices can typically change. It takes, and those like banks take a while for them to loosen up. They're pretty quick to cut it off. It takes a while to loosen up, right?
On that topic specifically, the loan types that they just decapitate immediately are luxury and investor loans.
Right. Like quick.
Yes. Yeah. But what's really interesting is FHA, an insured loan that they can sell, and you put down 3%, those loans never went away. But you take conventional or stuff that was not government insured, investor loans, luxury, they were gone. They were gone overnight. Yeah.
So it takes a period of 4 years to come off the bottom with any level of significance, but it doesn't take that long to come off the top, to come off the peak. That peak turns pretty quick like.
It does. And what this is all a money-driven exercise. So the cost of capital, as we can see the last several months, has risen significantly. You've got, investors that do the buy and hold strategy, and they go for their refi. They're expecting 3 or 4%. And now they're getting quotes at 5, 6, and 7% for the exact same loan. So that's where the cost of capital and also the amount of capital in the market retracts. And so when people can't operate on credit, then the cash buyer becomes the primary buyer, which means your demand pool is down. Supply and demand, 101.
Yep.
All of the things being equal, demand goes down, price goes down. So
let's talk about supply and demand. In an upward rising market, when you're pricing things out and you're deciding what to buy it for and where's it going to be in the event you exit, if you're going to wholesale it, or if you're going to fix and flip it some period of time from now, how do the actives, the pendings, and the sold comps, how are you looking at those? How are you identifying those in an upward market? And how are you viewing those in a downward trending market?
Sure. I think it's very simple, and I'm glad you use those two because that allows me to create a very easy analogy. In an upward market, you'll see that the active is here, the pending is here, and the sold is here. So what happens is the stuff that's sold is lower than the stuff that's pending, which is lower than the stuff that's active. But in a downward market or a market that starts to soften, what you'll see is that the solds are up here, the pendings are a little bit lower, and then the new stuff coming on the market is lower again, the actives. And so what you'll find is it's basically the complete opposite. The reason that's so important, if you use an AVM and any kind of an automated valuation model, what happens is they just look at solds. And so you miss 2/3 of the picture by using any kind of an automated number. And it doesn't account for market conditions. It just tells you what's sold, which is like we just spoke about, 1/3 of the picture.
This has been my criticism of appraisals, right? Because the format in which an appraiser is forced to comply with is that there's so much emphasis placed on sold comps that it doesn't accurately reflect what's transacting or what's transpiring right now in the marketplace. Real-time data.
It works both ways. It could be
correct.
Appraisal's too high or it's too low because it's not accounting for the active and the pending. It's not for the actual stuff that's currently happening in the market. It disregards that information.
Yeah. And for those who are relying, if let's say we passed the peak, I think we have, but I think we're we're recording this in the middle of June. I think we've passed the peak for where we're at. Interest rates continue to rise. I think it's going to pull back a little, not a crash, but pull back. And so I think for those investors out there who are trying to comp out and use, predict where they're going to be on a rehab basis, 60, 90, 120 days from now, if all they're looking at is sold comps, their numbers may be way too high.
I agree with that. But I also would say that goes back to really the thing we spoke about before the show. The money in our industry is made on the buy.
That's right.
So if you buy at wholesale and you're predicting a sale at a realistic sale price, you have no buffer. But if you focus on buying stuff below wholesale, you have a built-in margin of error, which is the differential between what a wholesale price is already and what you actually paid. And so I consider that a first tier wholesale, second tier wholesale, or a primary wholesale and a secondary wholesale market. And so I'm always trying to buy at a price that is lower than what the secondary market, which will be essentially the investor that would buy off the MLS, use an agent, kick the tires. Yep. That to me is that secondary market. And so I've been teaching this for years and continue to implement in our business. It's not good enough to buy at wholesale because your only option is to add value in order to exit. If you buy something at a price today, what it's worth today, there's no equity.
Right.
It's like what people say, you don't have any equity. Because my question to you is, you buy it for 100 and it trades wholesale for 100, you have no equity. You have to add value and force appreciation. But if you buy it at 80, now you've got 20 grand in real equity day one. And so that's the strategy that's allowed me to continue to thrive over the last 18 years and going through that curve of buying and then losing everything and then building it back up again. I realized that you have to buy below wholesale. That actually would account for the exact scenario you said, which is prices soften a little bit.
Correct.
You already have that built into your profit.
You've got a buffer. All right. So let's go down that rabbit hole. How does one buy below wholesale?
So what you have to do is really understand who is the most motivated seller and who's the buyer. You have to understand the marketplace. Most people don't even have a basic understanding of the marketplace. Therefore, they don't know where to go. So if we take a trip down memory lane, after everything collapsed, the seller that controlled the inventory was the bank. And so if you were not buying from a bank, you weren't buying from the cheapest seller. Right now, the banks haven't been foreclosing on for almost a 2-year period.
Right. And
even prior to that, we saw a slowdown as early as 2017. Really, I think even before that. So we saw a slowdown in actual foreclosures, which means that as prices went up and foreclosures went down, the homeowner started controlling the inventory.
That's right.
So our philosophy is really simple. We go to where the most motivated seller that's most likely to sell us a property at a price that's going to be below wholesale. And today that's the homeowner. So our formula is simple: high distress, high equity. The reason I want both, I want to start with a distressed seller. I don't want to deal with someone I have to convince to sell cheap. I want to cut out half the equation, start with a distressed seller. I want to make a lot of money and not a little bit of money. So I start with high equity instead of low equity, let the competition go after the small deals, keeps them busy, keeps them distracted. We're going after the high equity deals with full force. And so as we look at this progression, seller direct was 80, 90% of our model.
Yep.
But now we have now introduced the short sale model because we realize the banks are going to take back control of the inventory. Now you might say, well, you're still dealing with the homeowner. Yes. The homeowner has to raise their hand and say, yes, I will do a short sale.
Right. But
the person who controls the deal is the bank because they need to approve the short sale. So that's a big shift our company's made this year to account for what we believe is coming. And as things continue to degrade, we'll be moving towards not only before the auction, which is the short sale, we'll be buying at the auction again. And then we'll be also transitioned to buying after the auction, which is the REO market. So this is not a static thing.
Right.
It's about moving with the market, seeing the opportunity and capitalizing on it. And so to answer your question, that's how we buy below market, buy below wholesale, because we are chasing the right seller at the right point in the market cycle.
Were you involved with short sales in the last cycle?
I sure was.
Tell me what your thought on what's going to be different this time around dealing with a bank on the short sale process versus last time around. Because last time around, it seemed like the bank had never heard of a short sale like any of us. And they were like inventing it as they went along with their process and procedures. Today's going to be very different.
Yeah, I think that's a really, really good question. I think what's good this time around is that the banks have a process What's bad about this time around is the bank have a process. And so I think that we saw a huge swing in the deals that we got due to the fact that the bank didn't have a process. Because essentially you got the right negotiator for the bank, built the right kind of rapport, and Bob and Mary or Mary and Joe, basically your person got along with their person, you get a great deal. And it was a very personal basis. Now everything goes through Equator. It's very hands off. But what's good about that is if the number hits, the number hits. And so for me, it's really down to one thing. It's having a seller saying, yes, I will work with you. Yeah. That to me is the biggest challenge you need to solve to intake a short sale file. And then the next hurdle, once the seller says yes, that's done. Yep. It's how do I get the bank to play ball? Right. And that entire process is driven around one thing. And people who truly know short sales know that the entire success of a short sale after the homeowner said yes is built around the BPO. So you need to become an expert on demonstrating to the bank why your BPO value is correct and your assessment of value is correct. Yep. To create a BPO that will allow you to make a profit. If you become an expert of that, as well as working with homeowners, convincing them that you're the right option for a short sale, there's a tremendous amount of money to be made. But I like the fact that they have a process now, because once I know the process, I figure out how to play and win. Yeah. And I'm really actually, I think the advantages this cycle far outweigh the lack of a process, because for me as a scaled operator, I can scale in an environment dealing with a seller that has a process.
Once you know the game, you know how to play it.
Yep.
It's when you got every other day, there's a new game, like last cycle. Their process, I mean, yeah, it was rough and bumpy. This one, we should be able to execute in that time frame, much tighter time frames, start to finish.
So just to give you case in point on that, a short sale negotiator that I am friends with completed a VA short sale in 53 days.
Wow.
Start to finish. And secured the asset at approximately 50% of UPB, and was able to work with their client and resell the property for a very, very healthy profit. So people have said to me lately, insured loans are harder than conventional loans. It's just not true. Across the board, banks have a process. Number one, you got to convince the seller. Mm-hmm. Number two, you've got to convince the bank, yes, we'll do a short sale. Number three, you've got to get the BPO to come in right. That is the 1, 2, 3 formula for short sales. Yep. And we're very much focused on building that pipeline now.
Yeah. It's tremendous how you already see the trajectory of this market, the cycle, and you're laying the whole foundation is ready for when the hammer drops, if you will.
Well, we have a team this cycle, which I didn't have last cycle. I got an entire team ready to go, that's smart, that's competent, that's able to execute on these strategies. And so for us right now, we're going to continue to buy from sellers. We're going to continue to wholesale. We're going to continue to flip, but we're also going to be heavily focused on building a pipeline. And like I told my closers this morning, the pipeline, the short sale pipeline you build in 2022 will take you all the way through 2023. And the pipeline you build in 2023 will take you all the way through 2024. Yep. So we're now planning 12 months out with this new addition to what we're doing currently.
Agree or disagree with me? Generational wealth is built in down cycles.
It absolutely is. You don't get wealthy at the top of the market cycle. You can make money, and you can make a lot of income. But where true wealth is created is buying something low and then watching that asset appreciate and selling it high. You can't do that if you buy at the top of the market. The wealth, your balance sheet is only going to go from positive to negative. For most people, if you've purchased assets, especially in the last 2 years, and that's where you've begun buying, your entire portfolio is very likely to be in the red in the next 12 to 24 months. So to further that point, an asset that I paid $30,000 for is now trading for $300,000. So I look at, I think about the stuff that we purchased at the bottom of the market. We bought stuff at a 30x multiple on rentals, which means, you pay $30,000 for something that rents for $1,000. In that case, I rented it for 8 years. I'm thinking about some specific examples. Yeah. That the rent on that is over $100,000. We resold the asset at the time at about $150,000. So I'm looking at deals where I made 8, 10, 12 times my money. It's just not possible to do that when you buy at the top of the market. Right. And people will try to justify this. Whenever you see someone making $100 a month in the rental, they're probably losing $100 or losing $200 a month, because I've used this example. I'll use it again on this show. An AC goes out with $3,000. You've lost rent for the next 3 years if you're operating off $100. And also, you don't have the benefit of appreciation. So using the right strategy at the right point in the market cycle is so key. Right now, it makes a ton of sense to flip assets, but to buy and hold something at the top of the market defies logic about building wealth by buying low and selling high.
That's
because you're saying, no, I'm smarter. I'm going to buy high and sell higher.
Right.
And none of us are smarter than the market.
No, that's exactly right. Take me back to 2008. Everything hit the fan, if you will. You got way more going out than coming in. How do you personally manage that? Past dollars and cents. I mean, literally, how do you personally manage your day-to-day and the relationships in your life?
When I lost everything?
Yeah.
I would say I went back in my shell for a little bit. So there's about a 2-week period where I didn't get out of bed. And then at that point, I had breakfast with one of my mentors. And I said, his name was Bumper. He'd passed since then. And I said to him, really like wealth of knowledge, a guy with a lot of life experiences, both good and bad. I said, Bump, what do I do? And he said, son, I'm waiting for something epic, like really epic. Yeah. And he goes, son, I'm like waiting there at breakfast. And it was like Mama's Kitchen House or something like this dumpy little cafe, but it was good. It was the company I cared about. He said, son, sell your way out of it. And I said, oh, that wasn't what I was expecting. But his point was the only way to dig your way out of a hole is to create new income. So I was relentless on only having money come back to my bank account. I didn't have any money to invest. And the way when I looked at the marketplace, I realized the only way to just pull money out of the market was wholesaling. So I went all in on wholesaling. And I just got checks coming in almost every single day, 3,000, 5,000. 10,000, and it doesn't take long to build a bank balance when your overhead's low. You're not putting any money out of real estate. Money's only coming back in.
Right.
I'm normalizing it now, but that was a tough time when you just figuring out how to stay in your house and not get kicked out of a house. That was a tough time.
Yeah. Where was your head then? It seems to me like there was a small lull, as you said, going back into your shell, and then you just got focused on fixing it.
Relentless. I was relentless. Yeah. The feather that I had in my cap was I was relentless. And I say to everybody out there, when you're down and everybody thinks you screwed up and everybody's pointing the finger at you and you feel like you screwed up, just determine that you're going to be relentless and be relentless in winning. But don't do that blindly. Take a quick step back, look at the market, look at the opportunity, figure out a strategy where you can capitalize on what's happening in the market instead of fighting the market. And then be relentless in your execution. And that's what carried the day for me.
What I hear you saying is you also didn't second guess yourself. You identified that, you created a plan, a trajectory, and then you executed.
There was no other choice. When your back's against the wall and you don't have any money and you've got less than a month of income. I mean, I wasn't down to $20 on any of these stories people say on shows. I mean, I think I was down to about 20 grand, but that was a far cry from $2 million.
Sure.
And I had to figure out how to turn that 20 grand into an income where I could grow my wealth again. And so that was a very, very challenging time, but I learned a lot. 2 big things for me. Don't try to do it by yourself. Get a mentor, get mentors. So you get multiple points of view. Yeah. And a mentor is not someone who makes cool videos on Instagram. A mentor is someone who's been where you want to go, has demonstrated success.
That's right.
And particularly success in the industry that you're in or where you're trying to go in that industry. You know, you can have a fitness coach that knows nothing about real estate. You can have a real estate coach that knows nothing about fitness. And I've always tried to not get out there. I mean, I'm divorced at this point. I'm not giving people marriage advice, I'm not giving people advice on kids, I'm not giving people health advice. But the thing I know is how to survive a market cycle. And I've been around people, the mentors in my life have been through at least 2. In fact, my 2 main mentors have been through 3 market cycles. And I listen to those guys. And also, when it comes to wealth, I don't listen to anybody with any advice on real estate unless they have a net worth over $100 million, because that to me is the next level above where I'm at. And so that way I can listen to someone who has more financial capability than I currently do. So I think it's solid advice for most people out there. You know, really choose your mentor carefully.
Well, decide where you want to go and then find somebody who's already been there, done that.
And also that leads to another point that while we're on the topic, You can have multiple mentors in different areas of your life.
Sure.
You can have someone, I'm not a big fan of life coaches. So if you're a life coach, I'm sorry, I'm not trying to offend you, because that's almost like saying I master life, but I want to find someone who's good at fitness, someone that's good at finance.
That's right.
And also the real estate investor that knows how to make money may not be the person that knows how to manage money.
No, that's totally couldn't be anything.
A big difference.
Huge difference. Yep.
Huge difference between making money and keeping money. And then there's a third skill set. When we talk about this money game, making it, keeping it, the third step, the person that knows financially how to keep it may not be the person that knows how to keep the government away from it. And that's its own skill set, which is understanding taxes and how to pay as little tax as possible while legally operating a business. And so even just in real estate, there's 3 different skill sets, and the mentor you choose may not actually have mastered all 3.
No, that's true. And then your second piece is, build a team. You're not going to do it all yourself. And oftentimes executing on all 3, you may have a mentor in 3 buckets, but executing all 3 buckets may mean different team members, both internal and external.
Absolutely. And I can tell you, before I used to teach people and systems and processes, but now it's 80% people and 20% systems and processes. You cannot do this without a team.
Right.
The other thing I've realized too is that focus is key. Trying to do a bunch of things poorly, you execute nothing well.
Yeah.
By being focused, for me, the magic number is 3 things. When I get overwhelmed, if I'm trying to work with more than 3 things, and so I'm really good right now. Medical cannabis, we had a large exit last year. We're about to do an even larger exit this year. And so that to me has been a vertical I've been focused on for about 7 years, almost going on 8 years. Yeah. Real estate is something I've done. I've just engaged different tools in my tool belt now that I understand market cycles. And then my passion project, which also has huge financial capabilities, an NFT project where I love the fact that people have paved the way with products and services that make no sense. And it's created a lot of buzz around this industry.
Correct.
And people in crypto are dying to put a safe place for their money that's decentralized, because just owning the currency and not investing in something means you're losing money at the moment on a daily basis. So I think we're poised front and center to really capitalize on what's happening there too.
You know what? The buzz in the NFT over the last year to me feels like the buzz when, Bitcoin like 6-7 years ago went from, 500, 600, 1,000 and ran up to 19,000 and change, eventually retreating, and then, kind of
temporarily hit 3,000. And the reason
for years
I was trading Bitcoin and I've made a lot of money. Yeah. Not because I'm an expert, because I look at market cycles and I buy at obvious lows and I've sold at obvious highs. Yeah. Right now, we don't hold Bitcoin. It's actually in the buy zone for us right now. Yeah. We think though that could degrade as low as 10,000, 12,000, somewhere in that range based on our analysis. But yeah, for sure, I was encouraging all of my friends with large Bitcoin holdings. As soon as it hit 60,000, I said, "This is ridiculous, guys.
Correct.
Like, park it in USD and keep it in crypto, move it back and buy more Bitcoin, but get it out of Bitcoin." And I watched some people really win on that, and I've watched some people crash and burn. So it's definitely been a mixed bag, depending A, where your basis is, and B, where you get off the merry-go-round.
Or you get off the train. Yeah, exactly right. Let's do this. I want to move on to the final segment, what I call for impact.
Sure.
All right. Your favorite quote, "Let's freaking grow." You said it. What about that resonates with you? I mean, it seems like almost like it's I'll put a label on you. It's almost like your motto. You want to grow, you want to push, you want to create new levels, new next best. Where did that come from? What's the genesis of that in your life?
There's 2 places you can be in business. You're either growing, you're dying. Yeah. And the reason being, it took me many years to figure out why that was the case. Because the third question in everybody's mind, why can't you just stay where you are? The reason being is every marketplace is competition. Yeah. So if you're staying where you are and the competition's moving forward, you naturally fall down the road.
That's right.
That is why there's only 2 choices. You either grow or you fall. There's no in between. And it's because of competition. And it did, unfortunately, took me years to figure that out, but there is no middle ground. And that goes back to what I was saying about being relentless. If you are relentlessly focused on the right business strategy, and here's the thing, you don't need to conquer the world every day.
Nope.
1% better, 1% better, 365% better a year. You will blaze past your competition. Most people in this world go in spurts and starts.
Yep.
The person that's consistently growing every day will bypass their competition over time. It's like the tortoise and the hare.
Yeah.
And it's been my experience, and I've seen other people that are successful. You just got to be consistent. One thing I found on that in one of my recent readings that I'd gone back over, and a book I'd read many, many years ago, only 3% of people in the world write their goals down. And so what's interesting about that is out of that 3%, they're 5 to 10 times more successful than the people that don't write stuff down. So an easy, very easy thing for everybody listening to this, write your goals down and prioritize them. And you're 5 to 10 times more likely to be successful than the person beside you.
Yep, you're spot on there. What do you think it is that holds most investors back from hitting their personal next level?
I think it's fear, and it's fear and trusting the process. And for me, the process is quite simple. You've done your analysis on the market, you've seen the opportunity, and now you create a strategy that's market driven. If you've done that homework, you're consistently execute on that, the success will follow. Most people don't believe and don't take that leap of faith. It's almost like Indiana Jones with that glass bridge. People don't want to take the first step because they can't see it. But once they're on the bridge, it's no problem. You get to the other side. And so I would just encourage everybody, if you've done the analysis, hit the go button. Imperfect execution is way better than planning. If you have to choose between the two, although planning is good, planning with no execution is a waste of time.
Correct.
The other thing too is starting with a goal. Most of us don't get in a car and just drive. You say, I'm going to the store, and then you get in your car. But yet in business, a lot of people say, I want to flip houses. And I say, well, what's your goal? I want to flip houses. And then I say, well, what else do you want to do? Well, I want to own rentals. That's like getting in your car and driving in circles. Yeah,
you're totally right. They're different businesses at the end of the day.
Of course, yes. That one is a operational and management business. And then the other one, is purely driven by how low do you buy it and how quickly can you sell it at market value.
Yeah. So, outside of real estate, what are you most passionate about?
Cannabis.
Yeah.
Yeah. I'm actually not a big cannabis user, but I love the medicine. I like the science. I love where that industry is going. I love being a pioneer, and I love the growth in the industry. And we're just
it still feels like infancy.
Oh, absolutely. We're pro forma for our new model. It's just showing year 1, 12 million, year 2, 55 million, year 3, over $80 million with an enterprise value in 3 years at $250 million. I mean, you just don't see that in most industries.
No, you sure don't.
And even now between 22 and 25, the market is expected to double. And fun fact for you and everybody else out there, the cannabis industry on retail sales is expected to exceed tobacco in the next 3 years.
Wow.
We all know that tobacco is a gigantic. No, I'm talking about the legal cannabis business.
That's right.
Retail side is, and that's not even counting all the ancillary services. If you count that, it's 3 times the size of the tobacco industry.
It's incredible.
I mean, it's nothing like it. Right now, real estate's not going to double in the next 3 years, but cannabis is. And I feel like we're front and center in an industry that's growing and just right on the forefront of being pioneers in that industry.
A question on this related subject matter. Tobacco 10 years from now, is tobacco on the way out the door? That's my question.
I don't believe it is. Yeah. I think that we're talking about a business structure that's built around people's vices, and there's always going to be a market for that. And so they've done a good job on understanding their customer base, which is why you've got dozens of drugs within that drug to make sure that they keep people on the hamster wheel. Just like it's no different, by the way, than the pharmaceutical companies. Sure. Pharmaceutical companies will send you a pain pill that gets you hooked, and then the same company will sell you a pill to get you off the pain pill. Yeah. So I try to be realistic that everything in this world, when it comes to a business perspective, or most things that in for-profit industries are driven by money. Mm-hmm. So I'm always just looking for ways to capitalize on things where I'm not violating my moral compass, but I try not to question the business ethics of people that are businesses I don't own or control. Yeah, no, that's fair. What's your favorite way to make an impact in the community? My favorite way to make an impact in the community is just doing good deeds and looking out for people in my circle and my network and quietly doing deeds to help people. They don't have to be Herculean efforts. It could be money, it could be time, it could be effort, but it's keeping your eyes and ears open for things that are impactful. And so on a personal basis, that's something that's very near and dear to my heart. On a corporate basis, the one and only charity that we support is Redefining Refuge, which takes in trafficked women, rehabilitates them, and gets them away from their captor, their pimp, whatever you want to call them. There's various names for those people that mentally, in some cases, and physically capture those women, and they get them back into society with a skill set and a job, and make them, just send them down a path that's much better than the place they came from. And I'm very, very passionate on that topic.
Yeah, that's tremendous. Well, Lee, for those who want to connect, they want to learn more about you and what you do, how can they do so? Where can they find you?
Sure. That would be Real Lee Kearney on Instagram. Again, that's Real Lee Kearney on Instagram. That's the easiest way to connect with me.
Perfect. We'll make sure we get that link in the show notes here below.
Perfect.
Lee, I really appreciate you taking the time up. It's a wonderful story in your life and everything you've come through to actually live as many places as you have, participate economically in as many places, owning real estate, and then identifying market cycles. I think that is, and especially as we start coming through one, that those words are going to be something that really come to the forefront of people's conversations and discussions. And I couldn't agree with you more. Your ability to identify the market cycle and the entry points of the market cycle are almost more important than, what particular asset you buy, given all things being equal. So it's fun to hear that. And then how you dug your way out of a hole in 2008. It's really inspirational.
Thank you. Well, I really appreciate you having me on the show. And hopefully I've said one or more things that can help people out there that were listening to this. So.
Yeah. Absolutely. No, that's great. I appreciate the time, Lee. For everybody here at Real Grit, I'm Neil Timmins, reminding you that real estate requires real grit. See you next time. If you like our content and want more, you can access it at realgritpodcast.com. You hear it guest after guest. Instinctively, you already know it. But let me call it out. The most expensive action is inaction. The real estate market is full of opportunities. You just need to uncover them. You can build a business that lasts for years, makes monumental impact in the lives of those that you love. It's not just about business, but about the freedom you get because of it. Have you ever heard the saying, if you want to go fast, go alone. If you want to go far, go together. I believe that partnering is essential. In fact, I partner with hardworking investors all the time. The point is that you can get a lot further with the right partner. Let me say it again, the right partner. If you've ever thought about partnering with anyone, or if you have a partner now, I encourage you to download my free Partner and Profit Guide, which includes the top 5 must-answer questions to evaluate a profitable partnership. You can find it at www.legacyimpactpartners.com. I'll see you in the next episode.